Hello, welcome back to the channel. So in today's video, I'll be covering some of my high quality compounding machine stocks that have been falling. So for reference, this is my entire portfolio. I'll be covering this one later on. And the first stock that I'll be covering is actually FactSet. So FactSet year to date is down around 36%. Post earnings, it's currently trading at around 19 times of earnings. So for FactSet, why exactly did the stock fall? So the stock fell because they reduced their earnings outlook next year. They also came in below estimates, and most importantly, they're actually spending money on AI investments. So the AI investment is actually driving down margins for this company, and investors are currently fearing that AI is eating their lunch, and that's why they're having to spend all this money on AI investments. So that was why the stock fell 10% on one single day. But for me, I think this was an overreaction. The earnings outlook was still decent overall. Although they're forecasting nearly zero growth in terms of net income next year, the company is still a decently high quality, predictable business that brings in recurring streams of revenue every single year. So if you don't know what FactSet does, FactSet is similar to Bloomberg Terminal. It's similar to Capital IQ, it's similar to Refinitiv. What they do is they provide a subscription-based business model. And if you've used their terminal before, their interface is actually a lot better than Bloomberg. So they're currently now the third place in this terminal industry. So the first one is Bloomberg with around 30%, the Refinitiv at around 20%, and then the third place is FactSet, which is at around 6%. So their main target audience will be your hedge funds as well as some of your universities. And for your hedge funds, what they will normally do is they will pair Bloomberg with Refinitiv or Bloomberg with FactSet. So for FactSet, it is a decent company and the interface is better than Bloomberg overall for me. And this could be an interesting company if you're looking for a high quality recurring revenue business with 5% revenue growth as well as some buybacks and dividends coming in every single year. So if you're to add the 5% dividend growth and the 5% yield that the company is giving out today, without multiple contraction and without multiple expansion, you can get around a 10% return from this company here. So for FactSet, I think this was an overreaction. The company is trading at a decent valuation today. It could look interesting if the stock continually falls further. So after FactSet fell, there was another company in my portfolio that fell by quite a fair bit as well. It is one of the highest quality companies out there, and this company is S&P Global. So S&P Global actually fell 7% in one single day. The stock is currently trading at a 39 times of earnings. So for S&P Global, they have a few business lines here. So I would like to touch on them. So first one is your market intelligence. What they do is they sell data. Similar to FactSet, they provide data through Capital IQ and other business lines as well. Besides that, they have the core business, which is their ratings portion. The ratings portion is the one that makes S&P Global a lot more high quality as compared to FactSet. They have commodity insights, which is similar to market intelligence as well. That portion is a data business with recurring streams of revenue. They have their mobility portion that they are spinning out soon. And most importantly, they have the indices portion as well, which is incredibly high margin and incredibly fast growing as well. So for S&P Global, they actually raised their guidance in their recent earnings report. So this sell down is likely an overreaction. So the market just extrapolated what they saw with FactSet, and they think that S&P Global will suffer from similar consequences as well. But for S&P Global, this is a high quality business. And there's another tailwind for this company as well. So your debt wall maturity is actually coming up. Your debt wall is expected to peak out in 2028. Couple that with lower interest rates over time, this could be a tailwind for a company like S&P Global, as the debt market globally continually increases with lower interest rates as well. This could be a tailwind for a company like S&P Global. So for S&P Global, just some simple valuation here. So I actually put a 13% growth all the way until 2028, which is around 4 years from now. And then I reduced the growth, I tapered it down to around 10%. So putting in these estimates here, the company is currently trading at around fair value. I think the company today is a decent one for you to look at if you're looking for a high quality compounding machine. So for S&P Global, this company is a high quality one that got brought down because a rival missed on earnings. And overall, the Capital IQ portion only makes up around 15% of their entire operating income. So I see this as an overreaction. The company is fair value today. And if you're interested in the company, this could be an opportunity for you to start a starter position. So a similar company that I hold as well as Moody's. So Moody's is currently now around 1% of my entire portfolio. This stock was down around 5% in one single day after that FactSet earnings report. The company is trading at a 41 times of earnings. So for Moody's, it is a high quality business than S&P Global for sure because of your credit rating portion. your credit rating portion is a lot less prone to disruption as compared to your data businesses. And for Moody's, they have a lot more of their revenues and income coming in from the ratings portion. But the problem with Moody's is simply just the valuation discrepancy between the two companies. So for example, if you have to look at Moody's as well as S&P Global, Moody's is currently trading at a price to free cash flow of around 36 times, whereas S&P Global is currently trading at around 28 times. So the valuation discrepancy there is why I'm more drawn towards S&P Global. The 8 points difference in terms of valuation doesn't justify the difference in the quality of the businesses. So if you're looking for a high quality credit rating company to invest today, I think S&P Global is probably the company that you should be looking at. Next portion, I'll be covering a stock that I recently just added into. This company is Otis. So Otis is down around 2% year to date, trading at a 23 times of earnings. So I started a position in this company. It's currently now around 1.38% of my entire portfolio. I'll be looking to build this one out, but I'm currently still digging into the company even more so that I can build up conviction over time. So for Otis, if you are to look at their recent earnings report, their new equipment portion is actually the one that is weakening because of China. So China currently makes up around 17% of their entire revenue portion, and China's housing market is weakening. Contrast this to their installed base portion. Installed base portion is growing quite decently as well, so up mid-single digit, which means that if everything else stays the same, then the net income can easily grow at around 10%. I'll talk about this later on. So for Otis, there's optionality because the macroeconomic environment in China in terms of your housing market is weak right now, and it will eventually recover. And when that recovery comes, this could be a tailwind for a company like Otis. So for Otis, the company now is doing around 2% in terms of buybacks, 1.8% in terms of dividend yield. So that's around a 3.2% shareholder yield. And besides that, if you're to account for the 1 to 2% price increase in terms of the installed base portion, that would mean around a 4.5 to 9% increase in terms of the overall net income of the company if their new equipment portion remains constant. So once the China portion starts to recover, this could be a tailwind for a company like Otis. It is a macro bet as well, and the Chinese housing market is slowly recovering if you were to look at some of the data that the Chinese government is putting out. Last portion, I'll be covering some questions left in the comments. So the first comment, it says, also, you continually look for more companies to add to your portfolio. You buy all these great companies but lower your portfolio concentration in the process, something Warren Buffett isn't a fan of as it hurts your performance. Are you actively trying to lower risk by diversifying? And wouldn't that go against your strategy of going for high growth? What is your philosophy here? So my overall preference is to build out 10 positions, 10 highly concentrated ones, 10 core positions. I would say for my current portfolio today, I currently have around 7 core positions. So it's Visa, MasterCard, Microsoft, Amazon, Google, S&P Global and Moody's, that's considered one as well, and a Singapore holding, that's around 7 holdings in total. So my preference is to have highly concentrated positions into 10 core companies, and then to have some side bets as well on the side, which are mid-term holds. So for example, United Health was a company that had asymmetrical upside. That is probably a mid-term hold company as well. As for diversification, generally, diversification is diversification. I believe in the notion that concentration leads to outperformance, and that is something that I'm actively trying to pursue. Not all the companies that I discuss in the videos are bought. In fact, I don't own majority of them. I only buy the highest quality companies out there, and most companies don't fit this bill. Next two comment, it says, may I know your thoughts on Transdigm? And then there was another comment that talked about BYD, Trade Desk, as well as Salesforce. So I'll cover Transdigm first. This company is a decent quality one. The company has incredible pricing power. So what they do is they buy smaller businesses, they buy the patents to all these different companies, and then they bring them in, and then they hike prices by thousands of percentage. So the company is an unethical one, but the business model has been working for a very long time. I think for a company like this, it would be an avoid for me. It is unethical, which in the long term will probably hurt the company soon. So that's an avoid for me. As for BYD, Trade Desk, and Salesforce, I'm not too sure about Trade Desk. BYD is a company in your automotive industry. I generally avoid those companies. As for Salesforce, I'm not too keen on their CEO, Mark Benioff. His capital allocation isn't the best, in my opinion. I don't like his acquisitions. I prefer companies with organic revenue growth. And for Salesforce, it's a company that is actively trying to pursue acquisitions. In fact, they overpay for acquisitions rather than return it to shareholders. So for me, that company is probably an avoid today. although it looks undervalued relative to the entire market. I hope you guys have found this one useful and invest safe.